Hello.
Hello.
Welcome to another episode of what's the name of our show again? Don't say it. Passive Income Active Wealth.
Okay, so that was a rhetorical question.
We are Carolina Capital Management. We do loans. In case you're wondering, our website is carolinahardmoney.com. If you're a borrower interested in borrowing money, then click on the Apply Now tab. If you're an investor looking for passive income, then click on the Investor tab. Don't forget to share, like, subscribe, all that stuff.
Hit the bell.
Yeah. And this is Bill Fairman, and I'm Wendy Sweet, and this is Jonathan Davis. Oh, you were? I'm sorry.
I'm not finished yet. We also have comment sections, or if you want to ask us any questions, then you can put it in the comment section. And again, depending on your platform, it's either going to be to the side of the screen or it's going to be underneath the screen. So, how's everybody's day going?
I went to the bank without hitting a car. It was great.
That's right. We told that story last week.
Yeah. If you weren't here to hear it,
it was a good one.
Jonathan was on the phone with us, and I heard a little bump, and he went, "I got to call you back." So he was backing out of a parking spot at the same time somebody else was backing out of a parking spot right behind him, and they kind of met in the middle.
That's not the best part.
Yeah, in the haste to get out and talk to the fella, Jonathan left the vehicle in neutral and rolled across the parking lot into somebody else's car.
A much nicer car, right?
Yeah.
It was a Lexus. Yeah. Of course it's a Lexus.
So, I mean, it's like one of those America's Funniest Home Videos.
Wasn't so funny, though, was it?
No, it wasn't funny. But it would, it all worked out.
It's life, isn't
Well, that
it?
was the beautiful. The funny part was, it was my personal banker's car that I hit. So
that is funny.
Yeah.
Should have lent me more money.
That's right. That's right.
All right. So this is our ugly question segment, but of course we have
news.
Weekly news we like to share. So. Not all of it is actually breaking.
It reminds me of Saturday Night Live with Jane Curtin and Dan Aykroyd.
I'm not going to go. Yeah.
Jane, you ignorant. Oh, anyway.
Thank you. So a couple things. The employment numbers came in this morning, and they were higher than last week.
898.
Yeah. And they were expecting 825. So they were higher than expected.
And the previous week was what, 840?
So it was a little lower, I think, if I remember correctly.
No, the previous week was 840, and then it went to 898,000. Yeah. So and they were expecting 825.
And then the what do they call it? Recurring or recurring. Anyway, that's at 10 million and some change. So the numbers are trending the wrong direction. So that's another reason they're screaming for stimulus, but that's not going to happen. Nothing's happening. I can tell you right now, nothing in government is happening until after the election.
That's right.
Everybody is positioning themselves.
Right.
Yeah.
And frankly, I'm kind of hoping that they position themselves in a way that nothing will happen in the next 4 years either. Because typically when you have government gridlock, they can't figure out ways to waste our money. Right?
I don't know that that's a possibility.
All right. So that being said,
but they really use the rolling 4 week.
You never take individual weeks. It's you have to go by trends. Mm-hmm. And 1 week doesn't give you a trend. It gives you a snapshot.
Right.
And one of the things that I thought was interesting, we were in your office, Bill, talking about it this morning, was the confidence of certain sectors.
We love those confidence
I'd be
surveys,
interested in hearing that. So what are you hearing?
Well, it was, just the confidence in the financial industry was, and when they do financial industry, it's usually investment banking, wealth management, stuff like that. it is trending downward. A lot of wealth managers and financial investors are feeling less confident about the security of their job, the longevity of it, which is, music to my ears, because this means more people are, well, it's one or two things, or either not investing at all, or they're investing in alternative investments.
Right, not your normal stocks and bonds. And
well, there's another one you want to add to that.
What's
Tell
that?
me.
The proliferation of no fee
Big word.
investing. So you have an app called Robinhood
Mm-hmm.
where you don't need a broker. You don't need a wealth manager.
That's true too.
You
Yeah.
just do it all on your phone.
And people are internet oriented.
You've got Schwab and a bunch of others that are doing, no fee stuff.
Yeah, no fee, but we charge you for every transaction.
Yeah.
They make actually more for the transactions.
That's right.
Basically, they're all. It's like a lot of things. They're racing to the bottom on cost, and you've got people that aren't looking out for you. Again, most in that industry aren't looking out for you anyway. The only people that are actually looking out for you are your, what are they called?
Crooks?
No, the financial planners.
Financial
those people,
advisors.
They get paid based on you paying the fee, not the companies that you're selling stock for.
Yeah.
They're not getting commissions from the funds they're investing in.
Yeah.
They're getting paid by you.
Yeah.
And they are looking out for your best interest.
I was talking to a guy on one of my Wednesday with Wendy calls yesterday, and he's a real estate investor, but he also does a little day trading. And he said he's not on it every day. It's something that he just plays with, every few weeks or so.
By daily trading.
Exactly.
Yeah.
So right before COVID hit in January, he had decided that he was going to take his money that he had invested in stocks and sell them and put them into a self-directed IRA. And so he did. He sold it right before, and lo and behold, COVID hits. And I mean, it's within just a couple of weeks. So everything plummeted. And he, instead of putting it in an IRA, the self-directed IRA, because it was his IRA money anyway, he bought stocks with it again and doubled his money in a month.
Good for him.
Doubled his money. Isn't that cool?
Mm-hmm. Yeah.
So now he's taking the money that he was going to take out to begin with, leaving the rest in the stock, taking the other half, putting it in a self-directed IRA.
Yeah.
Fund to do lending with. He's in his 30s. He's a youngin'.
Yeah. Well, see, he can afford to do that.
Yeah.
Well, see, I took I had, a 401k, and I converted it into my self-directed IRA. And I did that. And then this was probably, a year ago. And when I did it, I was averaging about, I think, 5.8%. And since I converted to my self-directed IRA, I'm averaging 21%.
Well, that's a bit of an increase there,
That's
Jonathan.
a little bit of an increase.
Yeah, because real estate is always, in my opinion, I'm not a stock person. I'm not good at it. The first time I ever invested in stocks was back in 1987. It was October.
And she bought 100 shares of Apple.
No, it was on a Friday. I had saved up $2,500, and in 1987, that was a lot of money.
Yeah.
It was to me anyway. And I sent it to buy a mutual fund on a Friday afternoon. And that following Monday was called Black Monday. You may have heard of it. It took me 7 years to get it back to $2,500. So I don't invest in stocks. I just really, really stink at it. I feel so much more comfortable investing in anything that has to do with real estate, whether I'm a lender or fix and hold or buying notes or whatever it is that have to do with real estate. I'm so much more comfortable in being there because, when that Black Monday hits, it doesn't disappear. Even if I lose some equity, it didn't disappear. But man, it disappeared. It disappeared.
Yeah.
Disappeared.
Yeah, in a big way.
So,
so don't listen to me if you want to invest in the stock market.
Jonathan and I were having this discussion earlier today. I was watching one of the business shows this morning as I was getting ready, and they had a guest on. And one of the questions was, what's a a safe income investment. And then the first thing he said was, let's eliminate the word safe
Yeah.
and put in less risky.
Yeah.
And he says it's very difficult in this climate because interest rates are so low.
Mhm.
And, bonds are paying next to nothing. Everything that is bank oriented or bond oriented is just not paying anything.
Right.
You're not taking savers and rewarding them right now. We're not in that kind of an environment. And what shocks me is how many people still don't understand. Either don't understand it or they don't want to talk about real estate. Because his suggestion was the energy sector, and I'm like, what? That is a little volatile. Now he made sense. They do pay. Most of the energy companies pay a good dividend, and as long as you're with a good, solid company that's been around for a lot of years, they have a lot of cash on their balance sheets, and they are very largely capitalized companies. The likelihood of those dividends going down are going to be fairly low. But none of them still never mention real estate. And again,
no kickbacks.
Part of it is the people that are investing in real estate through the stock market are investing in REITs. REITs are concentrated on very large portfolios of A-class properties, and they can be commercial. And Class A apartment complexes and that type of thing. And the returns really aren't any better than what you're going to get with a dividend paying energy stock anyway, right?
Yeah.
So that's not really investing in real estate. And they're not going to mention the smaller players in the markets that really do have decent returns because they're not capitalized enough for them to even worry about it. The institutional investors aren't going to invest in like a fund like ours because they want to write checks for,
hundreds of millions,
500 million at a time.
We'd have a little trouble putting all that to work.
We couldn't put that much money to work. So
it'd take us a month or two.
We're going to be avoided, which is fine. I don't mind being overlooked because that means that we're not competing with them for that space. The last thing I want to mention in the news is that I was reading an article earlier this week on delinquencies. And it was interesting that the loans that were 30 and 60 days delinquent back in March or in April actually were, there was fewer of them now than there were in March and April.
Awesome.
So those actually went down. The problem is the people that were seriously delinquent, 90 and 120 days,
go away,
they actually went up.
Really?
Yeah. So basically what's happened is the people that have gotten real far behind aren't coming out of it.
Right.
And the people that were just a month or two behind, they were just temporarily closed. They've recovered or are recovering. So we're going to have some foreclosures coming down the pipe as soon as, depending on the state you lived in. The federal government is halting foreclosures basically on VA and FHA loans. They can't do anything about Fannie Freddie.
Yeah, I was just on the HUD website because, I'm a real estate broker as well. And the houses that are showing up on HUD in foreclosure have not increased at all over the past couple of months. And that's really what I'm looking for, to see if there are any houses coming up. So they haven't hit yet. I think
you would expect, if we have this, by the end of this year, first quarter of next year, you think that's probably when you're going to see those?
Yeah, I really do.
Okay.
Especially after the election, I think we're going to see the changes come along then. But, back between 2009 and 2000 and even 12, I could pull up just North Carolina alone, and there would be 200 to 300 houses on the HUD foreclosure list. And literally, there are less than 10 right now.
Oh, wow.
So that's a huge difference
Mhm.
of what it was. But you know, I see that making a serious change in a few months.
We talked about this before, but I wonder if banks and other financial institutions are going to be more cognizant of doing workouts with the borrowers,
Right.
because,
Or just selling the note rather
or just
than
selling the
foreclosing.
note, or whatever it is, some kind of workout or loan sale to avoid the foreclosure. I wonder if that's going to happen,
Yeah.
and if maybe we don't see that big uptick in foreclosures.
Right.
I don't know.
Even if I'm sorry, even if somebody with buys it as a non-performing note,
Mhm.
if it can't be worked out, it can't be worked out.
Then it's going
So
to be,
the foreclosure is going to happen anyway.
Mm-hmm.
Yeah, I suspect we're probably going to see a lot more note sales than foreclosures than we did previously. It's very difficult to pull these loans out and then go through the process, and they're really not built for it. They don't want to deal with it. I don't blame them. I don't like dealing with it either. You might as well have third parties deal with it by just selling the note at a discount. They'll do a charge off for the amount they are going to discount it for, and then sell them off.
Yep.
So, and there's plenty of people out there that are just waiting for that part, and I think that's a much
there's a whole lot of
more
people,
efficient system.
Yeah, a whole lot of people setting up distressed debt funds, and they have been for the last 6 months in anticipation of that.
Mm-hmm. Mm-hmm. That's very interesting.
All right.
Stuff. Good stuff.
So now for our lovely Ask an Ugly Question segment. See, we laugh about this because we all back here in the back know that Scott's lunch was delivered, and he might be in the middle of eating instead of pressing buttons.
That's so true.
Our question today. Did you have something to say?
Yeah, I wanted to say, if we started this out talking about investing in the stock market and how uncertain it can be. So your great alternative would be to invest in real estate, whether that's, if you don't want to be a fix and flipper, or rehabber, landlord, the best thing, we believe anyway, the best thing even above these is being a lender.
Yeah.
So what a great way to invest your money, right?
Yep. Yeah, by the way, I forgot to look at the comment section, which I should have.
Oh.
Did you notice that Scott said he invested that same
Friday that I did.
But they didn't execute it until Monday, and he made a small fortune.
That's good. Thank you for rubbing that in. I appreciate that.
Anyway.
So that just shows you what my luck is in the stock market. But yeah, this question. So the question we have for today is, if you are a lender, what questions should you ask the borrower? Mm-hmm. I do I do Wednesday with Wendy. It's a free mentor for an hour. I think I block out from 10 a.m. all the way to 2 p.m. I have a Calendly link that I put out there. If anybody ever wants to spend an hour talking about whatever type of real estate they're in, and I might be able to connect them with other people that can help them. That's really what that's for. But yesterday I actually had 2 people on there that want to be lenders.
Excellent.
That are, one guy had a substantial amount of money to do it on his own, but he also knew other people that he could use their money and basically start a company just like we did. Like, back in 2002, that's really how I got into the hard money, was using other people's money. So there's a lot of people out there that have a gazillion dollars in self-directed IRA custodians. There's a lot of money that's not being used, and people are afraid to, how are you going to direct it? What are you going to do? How can you trust who you are going to lend that money to? So there's a couple things you can do. One is you can let us lend it out for you. We've been doing this for years, but what we really want to do here is, if you want to try and do it on your own, we want to show you how to do that.
Sure. Yep.
And let the questions that you should ask. One of the things that really helped me get into this business in the first place is I am a recovering mortgage broker. I know how to underwrite loans, and we specialized, Billy did too, specialized in investor loans. They were the hardest ones to get done on a conventional basis, doing those conventional loans. So, so understanding the investor, how they're thinking, how the underwriter's going to think, that really, really helped me become a much better hard money lender.
Yeah.
And I learned the investing along the way as because I worked with investors. I think if you have any type of a real estate investor background, that's a great background to start off with,
Yeah.
and underwriting these loans as well. So, anyway, that's really kind of how we got to this point. So the question again is, if you are a lender, what questions should you ask your borrower? And we're going to probably go overtime on this, right?
Well, as lenders, we ask a lot of questions. So,
so the goal, so our first thought in anything we do is, if I have to take this loan back tomorrow, actually not if, when I have to take this loan back tomorrow, how quickly can I get rid of it?
yeah.
Right?
I mean, there's so many questions you have to ask yourself, and probably at the top of the list is going to be the borrower track record.
Mm-hmm.
Like, what's their history? What's their experience level? Those things are all combined into one. And, getting a track record, knowing, is this their first flip? Is this their 50th flip? That helps out. And then also knowing, getting a lender, like a reference of past lenders. What did those guys do when things went wrong? Because if they've done a few flips or a few loans, something went wrong. Did they do the right thing? Did they pay it back? Did they walk away? What happened?
That's right.
Yeah.
There's a couple of ways to find borrowers. I'm glad you brought up what you did is getting a reference. I think the best way to understand the character of your borrower is to get involved in your local real estate investor association.
Yeah.
Because those are the people that are borrowing money.
Mm-hmm.
And you can walk in and sit in the back and just see who the movers and shakers are.
Yeah.
Look and see who's doing business and who's not. And the subgroups, I think, is an even better way to get in there, get to know people. You're sitting across the table breaking bread, so you get to know what they do. People talk. Yeah. You know what's good, bad, and ugly about them, and it just gives you a better feel for what you're doing. As a new lender, like if I were just lending out my self-directed IRA money, I'm not going to lend to somebody I don't know.
Yeah, you want to, but I mean, remember that conversation you and I had the other day? We were talking about a loan, and this was a fairly large loan, and I was like, I don't know. And you said, hey, this guy, I've lent to him before in years past. This is what happened, and this is where it went wrong. But here's what he did. He did the right thing.
Right.
And when you told me that, I'm like, okay, all right, now, all right. The character means a lot.
It really does.
So that was very helpful in processing that loan and getting it through underwriting. When Wendy said, hey, here's what happened, here's what went wrong, because things went wrong, but here's what he did.
Right. It makes all the difference in the world.
Mm-hmm.
So that character, we can't say enough about it. It's still, I mean, the size company that we are, it still means everything to us.
Character means everything. You can have a great property and a borrower with terrible character, and it'll be a bad loan.
That's right.
You can have a mediocre, even like semi-bad property, and have a borrower with excellent character, and that's a good loan.
Yeah.
So character means so much.
Yeah, and we pull a background check.
Mm-hmm.
We pull a background check. We want to know, what they've done in the past and that kind of thing. So
well, and Wendy, you talk to every borrower pretty much that comes in and sends an application.
Yeah.
So
every single one.
Yeah, and what are the most important questions to you?
So the first question I ask is, do you know your credit score? Because I'm going to either waste my time, talking with, it's a 520. Oh, I can't even help you.
Well, why do you care about the credit score?
Because it shows whether or not they're paying their bills, just like it does for anybody else.
Mm-hmm.
And if they say, well, I don't really know, that always scares me.
Mm-hmm.
And then they'll try and throw out some numbers. So I know they're kind of tricky, but I love it when people say, oh yeah, I'm right out of 650 or I'm right out of 680. They know what their credit score is. It's important to them and they care about that. So I that's the first thing I ask. And then the second question I ask is, how much liquid cash do you have?
Yeah.
Some people are, and I know growing up, you were taught never to talk to people about how much money they have. Right? Do you remember that? You never asked somebody how much they paid for that. Of course, I'm Minnie Pearl with the tag hanging off my hat.
Well, we had that conversation too the other day. It was just like we've been lending for so long. Like, not that we don't, like money is important. And it's very, we all need it to live. But like we get jaded with the numbers, and like it becomes just a number to us. And it's like, okay, so this and this. Okay, got it. 50,000, 20,000. Those are just numbers to us.
Yeah.
And I think you're the same way.
Yeah.
You see, you're like, okay, 50,000, great.
Yeah. And the reason why we care about how much liquid cash, and I say liquid cash, I don't say how much money can you get your hands on or how much money do you have in the bank. I say how much liquid cash do you have?
How much available credit I have on my cards.
Yeah, that's what I don't want. And I'll get people that say, well, I have 5,000, but I have a line of credit of 20,000 that I can get a hold of. I don't want them to go into that line of credit.
Yeah.
That line of credit just means they're going to have another bill. So I don't really want them getting in there. So there are a couple things we're looking at when we ask about cash. One is, how good are they at saving it, right? Mm-hmm. And if you're an experienced investor, why do you only have $5,000 in the bank? There's something wrong with that. You need to have some money to be able to move forward in this.
I'm going to hear a lot of this, or at least I'm hearing this in my head, because people are doing it through telepathy, through the screen.
Oh, they're good.
They're going, okay, so when I started off, the bank says I have to have credit before I can get credit. Now, how do I get credit if nobody will give me credit?
Yeah.
Well, one of the ways of doing that is to getting a co-signer. And the same thing here. If I don't have experience in fixing and flipping, you're not going to make me a loan. Well, how am I going to get a loan if I don't have experience? How do I get experience? Nobody give me a loan.
That's
Partner.
Right.
Find a mentor.
Yeah.
Just the same thing as having somebody co-sign for you.
Yeah.
They're not going to co-sign for you, but you're not going to make as much profit. You're going to be doing a bunch of the work, a bunch of the leg work, and you're not going to get a whole bunch of the profit, but you're going to get the experience back to you.
But as a new lender, I wouldn't play with that guy, the one that needs the partner, the one that needs to get experience. As a new lender, or if I'm lending, I got $1 million and I'm lending it out, or I have 500,000 and I'm lending out, and it's just me and I'm just starting. I don't want to mess with that guy yet.
Yeah, if you're doing a self-directed IRA and you're lending out of that, that's the money that you've saved up, put there, and you don't want to lose it. So, I mean,
that's the key.
I'm not saying that you'll lose it if you lend to a new borrower.
Right, absolutely.
But it's usually a less likelihood of loss if you're going with experience.
Yeah. And we lend to new borrowers all the time.
Yeah.
But we know we've got to hold their hand through everything, right?
Yep.
We have to.
You don't have a full-time job doing this.
That's right. We have to. We really review the rehab list to make sure that everything on it is real. Like, you can't redo an entire bathroom, a full-service bathroom, for $1,000. It's not going to happen.
Yeah.
Also, if they have $9,500 on a regular bathroom in a $120,000 house, that's a little high.
Yeah.
So we're going to look at it and make sure that the numbers really match what they're trying to do, because we know that we want to help them get better, but we're also protecting our money. So,
yeah. And you can, it's not a foolproof plan, but a good way to tell an experienced borrower and a non-experienced borrower, just look at their tax returns. If they can get you your tax return. If they have no income, they're probably experienced.
That's about right.
If they have a high income, they're probably not experienced. So
that's about true.
Yeah.
So we really, really do care about the new borrowers, but as a newer lender, you need to really stick to somebody that's tried and true, that's done, and what is experienced. I want to see them do. To me, experience is, if you've done 2 or 3 deals, you've probably 3 especially, you've probably lived through enough enough mistakes to understand, okay, I need to do things in this order. And,
yep.
I've got a crew that I can trust, or you're just sitting in a little bit different position with that. So anyway, and that we really were talking about the liquid cash. Let me go back to that for just a second, because our next thing is, what is your experience? And we really hit on that. But the liquid cash, the reason why we care about cash not only is how good are they at saving, but the other thing is we know they're going to run into issues.
Yeah.
We release money in arrears. They have to do the work, then do a draw request. It gets inspected, and then we release the money. So they're going to have enough money to get the contractor started, and I want to make sure they have enough money to make the payments for at least 6 months. If that's the loan term, I want to make sure that they've got that, and they have to have money to bring to the closing table.
Mm-hmm.
The last thing I want to do is clean them out at the closing table. If they if they only have enough money to bring to the table, and they don't have any money saved to do to make payments or get that contractor started, that you are setting these people up to fail, right?
Yeah. I mean, making a loan is nice. We have to make loans to make money, but getting someone to pay that loan is just as important. So yeah, you want to make sure they have the ability to pay it.
Absolutely.
We would rather not make a loan than to make a bad one.
Yeah.
Oh, for sure.
Because it's a heck of a lot more work. Listen, even if we're not losing money, the return on effort is so outrageous.
Yeah.
Ask Wendy.
That's right. It all falls on me.
Yeah.
That's exactly right. And it's an absolute headache when you have to go after someone that is slow to pay, or they can't pay, or now you're having to do a deed in lieu or go through the foreclosure process. It takes your eye off of everything else you're supposed to be doing to take care of this one bad apple that's going on. And it keeps you from bringing in new business. So, it's not worth it. You really, really need to work with somebody that has good character, has cash in the bank, has some experience. And the next question that I want to know as a lender is, so what is your intention with the house? Now, we haven't even gotten to the house numbers yet, but what's your intention with the house? What do you plan on doing with it?
Yeah. I mean, are you flipping it, or is it a fixed to retail sale? Is it fixed to rent, new construction? What is it? So, what they want to do will determine further questions that you ask.
We got a loan in this morning. A guy wants to buy a single family house. It's a 700 square foot house. He wants to knock it down and put up townhomes. So he has to go through permitting process for the rezoning to make sure he can put 2 houses on this lot. And we want to make sure that he has approval to do that before we close, don't we?
We definitely want that. Yeah.
Because he could get stuck with a house that he can't really do anything with.
Or you try to do a fix and flip in an area that is known for buy and hold.
Absolutely. That's a great point.
Yeah.
You're going to have a difficult time selling that property because the buyer that comes in, unless they're an investor and you're selling a turnkey property to another investor that's going to hold it, you're wasting your time. You're not going to have homeowners wanting to move into areas that are full of renters,
right?
Because they don't have the same pride of ownership.
That's right.
The actual owners do.
And if your intention is to sell to an investor that would want to rent it, that's great. Your market went from here to here on who you can sell it to.
Right.
But, and it's possible people do that all the time, fix and flip properties for investors to pick up. So if that's you, then you probably have a long list of buyers that that are going to come in and buy those properties from you.
And in a lot of cases, they're pointing out what it is I want, and you're going to find it.
Exactly.
And then do the work.
Yeah.
Great point. That's a great point. Also, if it's a buy and hold, our biggest concern as a lender, because we're short-term hard money lenders, we are not long-term lenders. We want to know if you're going to qualify to get out of this loan and get it refinanced. So I always ask them, have you talked to a bank or whoever it is that's going to refinance you out of this house?
Yeah.
So we got to make sure they got the credit scores that'll work. And in today's market of 660 or higher?
Yes. I mean, 660. I mean, you really want to see probably 680 and higher if they're going to qualify for that.
They're also, this new bank is probably going to want to see 6 months worth of interest in the bank on this house that you're doing. And they'll want to see interest in the bank on any other houses that you have for 2 or 3 months. So you need to make sure that whoever you're speaking with will also qualify to get out of it. So in a lot of cases, we'll ask to see an intention letter, letter of
Letter of
intent.
intent.
Let
Yeah.
me spit it out.
Yeah.
A letter of intent from the bank that they're going to get it refinanced
Well, and
through.
and then also you have to, whoever they're refinancing it with, if they have the cash and all that, that's great. But does the property itself qualify?
Mhm.
Does the debt service coverage ratio work on that
great
property? So, you have to look at the market rents and what they're going to get on that property. And, let's say that they do qualify for a, 4.25% rate on a 20-year AM. Well, what's that DSCR? And you can figure that out. You just get yourself a amortization schedule. You can figure out that payment, and you plug that in.
All right, just in case we're talking above heads, explain what the debt service rate coverage ratio is.
Yeah, it's just the debt on the
that's a good point.
it's the debt on the property. Usually it's PITI, so principal, interest, taxes, and insurance.
Mhm.
So all of those things are the debt on the property, and then it gets weighed against the gross income of the property. So your gross rent of the property. So you divide those, and it gives you, typically they want to lend at like 1.2
Or 1.25.
1.25 debt service coverage ratio. So you need to be making
all of that payment with the taxes and insurance
plus 20% more.
Yeah,
They don't want a 1-to-1.
which
No.
you should be doing anyway.
Yeah.
Right.
It's not
If
a
the
good buy and
property only
hold.
covers itself
it's not a deal.
at a 4.25% rate and 20-year AM, you didn't buy it right.
Yeah, that's for sure. It's not a deal. Don't do it.
Yeah.
And don't lend on it because
Yeah.
you'll be owning it.
Yeah. And then on that same thing, the LTV, they won't lend above 80%. So you have to make sure your LTV there's enough cushion for that long-term lender to come in and take them out.
That's right. That's exactly right. That's a great point. So we've discussed, what is the intention of the house. So now we're kind of getting down to the brass tacks on the deal itself. My next question is, what is the ARV? What is the after repaired value of the house? When I get the answer, I'm not sure. I know that I'm dealing with somebody.
How would you know it's a deal?
Yeah, I know that they have no idea what they're doing, and they have just pretty much lost me on that one.
Yeah.
That is, if there's no other answer that you should know as an investor, it's what's the after repaired value. Even if your intention is to rent the property, you still need to know what it's worth. And just as important, if your intention is to rent the property, you need to know what the rent's going to be. How much you think you're going to rent it for.
And ARV is a pretty widespread acronym that every investor is going to know. So if someone says, "Well, what's ARV?"
Yeah,
that's another. That's another. Yeah.
Well, let me tell you about some investor groups you need to get involved with. Yeah. That'll help you get. Callbiggerpockets.com. Get online with them. So there's the ARV is the most important number that any investor should know. And if you're not getting that answer right off the top of your head, or if you're getting range, well, it's going to be worth between 140 and 160. That is way too wide a range to be estimating what that is. Wouldn't you agree?
For that size.
For that size. No, if you're saying 440 to 460, yeah, okay, I can get with you. But yeah, if you can't get it within $5,000 under 200,000, you don't know what you got.
Yeah. And I always ask them when they tell me what the ARV is, if they know it. I always ask them how they came up with that.
I always love that. I love their explanations.
Well, Zillow is a great way.
I just average realtor.com and Zillow together, and that's what I got.
That's right. I encourage them to find a real estate agent that can pull comps for them. Yeah. Not within 3 miles. It needs to be, when I pull comps, if I'm just doing a quick look at a house, I'm at a quarter mile out.
Yeah.
I really am. I gotta go a quarter mile.
Yeah, I zoom into the neighborhood, to the street, and then I work my way out.
Right.
And that's how you should look at it as a lender is, we want to get as close to the subject as possible. And then we start working our way out to find the best comps.
And the best comps are when was it built? If I'm looking at a 1952 house, I am not using a new construction property. I'm not using a 1990 property.
Yeah, I'm not using a 2015 property.
That's right. That's right.
Like, you cannot use new construction as a comp for a flip.
Yeah.
You can't. They're not the same.
I had one come in yesterday where somebody said, "Oh, this house is going to be worth between 240 and 280." Then I knew he didn't know what he was talking about.
Mm-hmm.
And then he said, "Well, we've got all these brand new neighborhoods all around." Well, when was the house built that you're trying to buy? 1953. Sorry, it's not even a close comp. And I really had to go out a mile to get other houses that were within the same build time that this house was to be able to pull the comps. And truly, instead of the 240 to 280, it was 230 tops.
Yeah.
On that. So,
and that might make it a more desirable area, but it doesn't make the house worth anymore.
That's right.
Or less.
That's right.
You have to compare with comparables.
Apples.
That's why it's called comparables.
and it breaks down. I mean, I think a lot of investors, new investors, get really fixed on this purchase price. And it really comes down to the price per square foot. It's really what it comes down to. New construction is going to sell higher price per square foot than your flip. It's just like, so if you have a 2,000 square foot flip and a 2,000 square foot new construction, you can't compare them. The price per square foot is going to be totally different.
Yeah, absolutely.
If you look at an appraisal, if you have a chance to look at an appraisal on the page that's specific to that property only, there is going to be a cost value and a sales value. And it's always going to cost more to build that house than it is to sell an existing house.
Yeah.
Why is that? Well, materials cost more.
And they're even worse now.
And they keep going
more,
up.
Yeah. Land costs more.
And it's a pain in the butt. You could buy an existing home for less money. Most people are going to do that.
Yes.
And that's why it's always going to be a higher cost to build than it is to buy existing.
Right.
Yeah, I've got a property I'm flipping right now in Concord, and the ARV is 285, and feel good about that. The new construction with the comparable square footage in that area is selling for 335.
Wow.
So yeah, I have the same square footage, but it's going to sell between 30 and 50,000 less than a new construction.
And it's rehabbed.
Yeah, and it's completely. I mean,
it looks new.
It looks new, but it's not new.
Yeah, so that makes a big difference. So the next question I'm going to ask after what do you think it's worth is, what is the rehab amount? Now, when somebody says, well, I'm not too sure. First of all, if they say between 5 and 10,000, I'm like, okay, they don't know what they're doing, because I haven't done a rehab that cheap ever
since 2005.
Yeah, and I'm going to change the value. That's not going to work. So when they come up with the rehab amount, I really want to know that they've walked through that house with a contractor.
Yeah.
And then when they tell me what the rehab is, I ask them to tell me what's on that list. I don't want details, but are you going to redo the bathroom, windows, roof, HVAC? What is it that you're planning on doing? And as they walk through, I talked to a guy just today that said, I know exactly what it is. It's $12,400. Really? What are you going to do with that? Well, I'm going to do a new roof. And I looked at the pictures. So I'm going to do a new roof. I'm going to paint the inside and outside. I'm refinishing the floors. I'm going to put in a new kitchen. And I said, wow. Yeah, boy.
Wow. Yeah.
You're way past the 12.4. There's no doubt about it. And so after we talked a while, it's really a $20,000 rehab that he's doing on this $130,000 house. So, once we walked through it, and he was still under the 65%. Yeah, so he had the cushion there to be able to do it right.
Yep. I think, I'm sorry, Bill.
I was going to say there are variances in cost, and it's going to be depending on your finishes that you use.
And your contractor.
That's going to determine, the finishes are going to be determined based on the value range of the area.
Right.
You don't want to put really nice stuff in an area that you're not going to get that back out of it again.
Right.
But you're not going to take a $500,000 house and put a bunch of cheap linoleum and stuff in it either.
That's right. That's exactly right. What were you going to say?
I was going to, as new lenders, because I think that's who we're trying to focus this on. As new lenders, I think it's easy to be persuaded or deterred from asking questions or feeling like you can't. Like, it's the golden rule. He who has the gold makes the rules.
That's right.
Yeah.
You can ask all the questions you want. And if someone's unwilling to answer your questions,
You don't need them.
maybe you shouldn't lend to them.
That's right.
So don't be afraid to ask questions.
Yep.
I like when people
Yeah.
say, "You're asking me for my tax returns. Why do you need to see them?" or you want to see my W-2s, or why do I have to show you my bank statements? This is like going to a bank. You are going to a bank.
Yeah, that's
we got money.
Yeah.
That's what it's for.
Well, that's the thing. They why do you need to see my bank statement? And it's like, or well, we got to make sure that you can pay the loan.
That's right.
Why do you need to see my tax returns? Well, I'll make sure you pay your taxes.
Yeah.
Make sure the social that you gave me, that's one way to verify it. There's a whole lot of reasons for things, not just because it's
You're
not
nosy.
because we're nosy and we
Yeah.
just want to know. It's like, no, you're giving, in a lot of cases, hundreds of thousands of
Yeah.
dollars to somebody.
Yeah,
You should get a few things.
that's right. You want your money back, not their house.
Yeah.
That's the key.
Yeah.
So the next thing, of course, is the purchase price, and all that wraps up into the formula. And I have done a formula. I wonder if Scott can put that up on the screen. It's a formula for what you should be doing as a lender. It looks like maybe Scott is having.
There he
we
is.
go. There we go. There we
No,
go.
he's still eating.
So, so if you'll look at this, and I hope you can biggie size this if you're on a phone. But there you go. Oh, Scott biggie sized it. That's great. So really, you're going to take the ARV, the after repaired value. You'll multiply it by 65%. You subtract the rehab costs. And what you have left over is the purchase price for the house. That's what they should be paying for the house. So my sample here is on a $150,000 house. Multiply it by 65%. The most that you can lend, or the most that you should lend on this house, is $97,500 if you're working on that 65%. Some people do 70.
Mm-hmm.
So then you take the 97.5, which is the loan amount. You subtract the rehab money first. That's what you want to control. So I'm going to take $40,000 out on a rehab, and what I have left over is $57,500. That's how much I, as a lender, am going to put toward the purchase of that house. Anything
Maximum,
above that
Mhm.
needs to come from the buyer. So that's really the formula that you as an investor should be using. You as a lender investor should be using, and you as a borrower should be using that same formula as well. Because you think to yourself, well, I've got a 35% margin that I can make profit on. Well, you know what? It dwindles really quick when you start paying real estate agents and payments to us and taxes and contractors that do a bad job and you have to do it over again, and all kinds of things that can come up. So keep that in mind when you're looking at that. And I know we're getting low on time, so I want to run through these real quick. The next thing is the time frame. You as the lender determine who you're going to lend to, what your terms are. Don't let them tell you what they'll pay. How much do you want to make? How many points or how much of an origination fee do you want to charge up front?
Yeah.
I think, if you're not charging 2 points as an independent lender, you're crazy, because that's really where your money's coming from, is on the points. Interest rate doesn't really matter that much. If it's a 6-month term, your interest rate really doesn't matter.
No.
8%, 10%, it's not.
Yeah, I'm the whole person. Rates don't matter.
Yeah,
but
they really don't. If it's a longer term loan, it absolutely matters. A longer term loan, you want your interest rate to be a little higher. So the shorter the loan, the shorter the loan, you need to care a little bit more about the interest rate. If it's a longer term loan, you want to make sure that it's an interest rate that you can live with over that 18-month period or 3-year period or whatever it is. And a point is 1% of the loan amount. That's what a point is. Great
100
question.
basis points.
Yeah. So those are total. Don't ignore what he says. That's high talk for
High talk.
That's high talk for a financial person. That was good stuff. When people are calling about a house, the first thing I do is I ask them the address. I pull it up. I look at it online on Zillow or Realtor.com. I want to look at the interior pictures while I'm on the phone with them.
Yeah.
Because when they're telling me about this house, I want to see the repairs. I really don't need to fix up the kitchen. Well, really, I'm looking at a picture. The kitchen looks like crap.
Yeah.
You're going to leave it like that?
Just going to paint the cabinets.
That's right. That's right.
Yeah.
Sure. They're
Yeah.
falling off and all kinds of stuff. So I want to see that addressed. We always get, 97% of the time we get an appraisal on every house that we do prior to the closing on it. In some cases, if it's properties that we really know, or we may have done a loan on it previously, or it's an extenuating circumstance if we don't get an appraisal before we close on it. We don't work off of a BPO.
Yeah. And you can always
broker's price opinion.
You can always work in a right size provision into your loan as well. So you can do a loan amount with a right size clause, which just says once the ARV or the appraisal comes in after the closing, if it doesn't come in what we think it is, we have to make the LTV the right size. So then the borrower has to bring, X amount to bring that loan amount down. But then you need to verify bank statements that they have it. Maybe you should escrow that up front. It can complicate things, but there are ways around it.
And it can work in the opposite direction.
Oh yeah, they can come in higher.
More money.
Yeah, they can come in higher.
Yeah.
Now, and why are you doing this? Because it's all about speed.
3 minutes.
Exactly.
And if you need to close this loan right away and you can't get an appraisal right away because we have issues right now with
Oh my gosh.
Right. Yeah, it's taken us a long time to get it done. So we have gone through everything we can possibly go through, right?
Really?
Well, there's so much more. Actually, we could do 10 shows on this.
Yeah.
But we don't have time. So you want to close this up?
All right, we're done. Have a nice day. So thank you so much for joining us. Again, we are Carolina Capital Management. Our website is carolinahardmoney.com. We do make loans. So if you're a borrower, click on the borrower tab. Nope.
We are fast at making loans.
Click the tab that says apply now.
Yeah. Yeah.
If you're an investor looking for passive income, then click on the investor tab. Don't forget to subscribe, share, and like our show. And if you have any additional questions that you might have thought of after we're gone, just stick it in the chat box anyway, because we do have people that will scour it and answer it for you and maybe add it to a upcoming show as well.
Bill has people.
That's right. And I do want to say this really quick. I got a loan in this morning at about 11 o'clock this morning, and we're going to close it tomorrow afternoon.
It happens.
How quick is that?
It happens.
Yeah.
And we ordered the appraisal.
No, he came with one, and it's an area that we know, so we can do a BPO on that one.
And if they do have an appraisal they bring to you, you can do an assignment of the appraisal, so you can assign the appraisal to you.
That's right. That's right. Awesome.
So have a great day. It was fun. We'll see you soon.